The balance sheet is a financial statement that provides a snapshot of a company's assets and liabilities at a specific period of time. More simply, it is a document outlining what a business owns and owes during a specific period of time. Assets are what you own, while liabilities are what you owe to others. The balance sheet is divided into three parts: assets, liabilities, and shareholders' equity. Though they are separate parts of the balance sheet, shareholders' equity still falls underneath liabilities because it is what the business owes. The difference between liabilities and shareholders' equity is that liabilities are owed to third parties, while shareholders' equity is owed to the owners of the business. If this doesn't make sense, remember that the balance sheet is of the perspective of the company itself, not the people who work or own it. The balance sheet is called that because it is meant to always be in balance, thanks to the accounting equation, assets equals liabilities plus shareholders' equity. Balance sheets can be made anytime. Many businesses choose to publish them at the end of their accounting year. Components in balance sheets may differ between companies and industries. I will show you a basic balance sheet and walk you through it. Now, let's talk about the components under assets. Both assets and liabilities are divided into two: current and non-current. For assets, current assets are assets that can be converted into cash within a year. Non-current assets can't be converted into cash in a year. On the balance sheet, assets are usually listed in order of liquidity. Liquidity means how easily something can be converted into cash. Everything here is current assets, which can become cash within a year. Cash and cash equivalents, also sometimes called cash and short-term investments, is what it says: actual cash, or things equivalent to cash or highly liquid, to be converted into cash quickly and easily. Inventory is the products in the warehouse that are yet to be sold. Receivables are the money yet to be paid by customers. Prepaid expenses are goods or services the business has paid for but hasn't received yet. Other current assets are current assets that couldn't fit in the previously stated rows. Total current assets are all the business's current assets added up. Everything here is non-current assets. PPE stands for property, plant, and equipment. This is their original cost minus depreciation. I explained depreciation in my PL account explained video, which you should check out by the way. Link is in the description. Goodwill is the difference between the price at which a business buys another business and the book value of the other business. I'll come back to book value later on in this video. If firm Y bought firm Z for $500 million, and firm Z has a book value of $400 million, then firm Z has gained a goodwill of $100 million. Intangibles are assets that don't exist physically, like patents, brands, franchises, etc. Long-term investments are for assets that have a value longer than a year. These include stocks, real estate, bonds, and the like. Other non-current assets are assets that didn't make it into the other rows, and can't be converted into cash in less than a year. Other assets are any additional assets of the business. And lastly, total assets is the added up value of all the company's assets. Now we're on to liabilities. This is also divided into current and non-current. Current liabilities are debts that are coming due within the year, whereas non-current liabilities come due in more than a year. Everything here is current liabilities. Accounts payable is money owed to suppliers. Accrued expenses are expenses incurred but that haven't been invoiced yet. Short-term debt is debt due within the year. Long-term debt due is debt that was longer than a year but is now due within the year. Other current liabilities are for the current liabilities that didn't fit anywhere else. Think of rows that start with Other as the drawer for everything else that couldn't be categorized. Total current liabilities is the total debt of a business within the year. Everything here is non-current liabilities. Long-term debt is debt due over a year from now. Deferred income tax is taxes that are due but have not been paid. Minority interest is an interesting little cookie. Example time. Corp 23 owns 90% of Corp 45. By that, I mean Corp 23 owns 90% of Corp 45's shares. When a company acquires more than 80% of another company's stock, it can shift the balance sheet of the acquired company onto its balance sheet. Corp 23 would have Corp 45's balance sheet numbers added to its balance sheet. Because Corp 23 doesn't own 100% of Corp 45, though it booked 100% of their balance sheet, the remaining stock Corp 23 doesn't own is put as a liability under minority interest. Minority interest is the value of the unowned stock of an acquired company. Other liabilities is for miscellaneous debt that doesn't fit anywhere else. Total liabilities are all of the liabilities of the business. Now we're on to shareholders' equity. Remember in my explanation of goodwill, where I mentioned book value a few times? Well, book value is shareholders' equity. They are the same thing. Like I said before, shareholders' equity is the money the business owes to the owners, the shareholders. Everything here is shareholders' equity. It usually has two kinds of stocks, preferred and common stock. Common stock gives ownership in the company, meaning common stock owners have the right to vote on the board of directors. It's more common and basic. Preferred stock doesn't give voting rights, but owners of this stock do get consistent dividends and are prioritized if the company goes bankrupt. Retained earnings are the profit kept to keep the business growing. Treasury stock, or treasury shares in the UK, is a company's bought-back stock. It's negative because it represents a reduction in shareholders' equity. When a company buys back its stock and decides to keep it, less stock is available for people to own, reducing the money owed to shareholders. Total shareholders' equity is the total of all the money owed to the owners. I hope you enjoyed this video. A like and sub are always appreciated. And you can leave a comment below on what could be better for the next video. Thanks for watching.